Hey traders, my name is Français. I hope that you're doing very well. It's been a while for sure because I'm very busy this day, as I already said to you on the previous video that we're working currently on the restitution, internal restitution of the GSTA, about the courses, about the price, depend on the for sure on the demand will be increased a couple of bit. So I will let you know about that and then make a proper communication of that. Okay, so I would like to thank you so much first for people which is send me a message to ask me about the progression of and the development of GSTA, and also the interest of the course, and also about my person. I do really appreciate for your it's very kind of you to take news from me, and we just want to let you know that we still keeping to provide you a best content ever, to create a proficient content and make the difference, and support you and make sure that you will success to the to have a success on the markets, and we continue that. Okay, it's just to all things that you have to do on your side is just to engage with our community, ask the question. You can take a look on the website also, and get enrolled to make the test your financial knowledge and those stuff to the blog section. If you can take a look quickly, and also keep continuing to subscribe to the YouTube channel and the Facebook page is really appreciate. We're almost reaching like 200 people on the YouTube, and also almost 500 on the Facebook page, which is, so it's very appreciated. Okay, so tonight I would like to talk about the currency war, right? Trade wars bring currency war, right? Because it's all about like strength report based on the biggest country, the global country on the economy, as the United States and China, and also we have an ECB in the middle, right? And that's why I create this model, which is basically is a variance model based on variance, which is oppose a basket of aggressive currency and defensive currency. Okay, so you can create that if you want. This is kind of advantage to work with TradingView, because we can experiment those things, right? And I will let you know, like I already make this study. I would just want to show you which one. So maybe I lost it. And if you're going on the TradingView and you search by the oil is the true boss of the financial markets, is exactly the same model that I would like to discuss tonight, and it's as I call the X factors of the market, because oil is all about the progression of the market, and it will arise the consequences for the this model based on the EXY, which is the current euro currency index, putting to the pound, the sterling, and also the Canadian dollar, and you will see the spread between the defensive currency, or the safe asset currency, which is the SXY, which is the Swiss franc, and also the GXY as the Japanese currency index. Okay, so this model that I show you, it's basically to let you know in which one contest are we now, right? And we see clearly that we are below 150, right? 150 mean that we are on an ultra QA, so the most of banks, central banks, starting to inject a lot of money for support the economy. And that's why we saw recently a tweet from Mr. Donald Trump, the tweet man. Okay, he said that he's not happy with the with Mario Draghi, because he was expecting that Mario Draghi pushing the euro up, right? And then it could make mechanically pushing down the dollar index, right? Because he really want to make the dollar very competitive. Then it could, like, he think that it could beat China on the on this, like, trade war, right? The fact is, Donald Trump, American President Donald Trump, succeed to putting the chairman of the Fed down to the wall, and as he indexing him as being the main responsible for the difficulty on the major indices, American major indices, as Nasdaq, Dow Jones, and the SP 500. Okay, and that's why the market has indirectly take account to the progression of the index. So when the president of China, Xi Jinping, and the American president Donald Trump make a good statement based on the trade war, like a positive communication, the market will react, not because they will be agree, because the market are already priced to that, right? They don't have a choice to be agree each other, because it's the too big power country, is the maybe the 70% of the global economy. So they don't have a choice to be agreed each other. So the market are already priced to that. But the fact that is precise that the J Powell, as the chairman for the Fed, must cut the rate interest as one or two this year, is something that putting the responsible of a Fed down to the wall, as you said, for index him as a you are the responsible if the market not going up. Okay, so that's why when J Powell looks like a neutral or a bit dovish, the market anticipate that the Donald Trump will be agree, like, by force with the president of China, which is Xi Jinping, right? And we saw recent, like yesterday at the Osaka summit for the G20, that the president of the China said he will remove all the threats which is looming to the global economy by maybe cancel all the sanction for the tariff on the American product. And also Donald Trump answered that he want to restart the discussion between the trade war, right, between China and the United States. You want to restart the discussion on the trade war. So that's why we probably anticipate that this, like, begin of this or this week for the markets, the index could going up, right? Because it's coming after that the Fed were very like sounds like a neutral or close to dovish, right? And the Fed, to just not be in central of this major problem, they said they will data dependent, right? Data dependent, which mean that they will just like stuck to the progression of the macroeconomic indicators and see if they have to intervene or not. They said that we will intervene to the market as the opportunity will be shown. Okay, so that's why I create this model for the statistical discrepancy, which is oppose the aggressive currency and defensive currency, as we see here the evolution of this model, because after the algebraic manipulation, you will find euro index, the pound, the Canadian dollar together. So it symbolizes the oil markets. That's why I said is the X factors, and also the XSXY, which is the Swiss franc index, and the JXY, which is the Japanese currency index. Those currency show kind of the safe asset of the market, right? And it depends which one countries that we are. If the market are worried about the progression of the discussion between them, and also we all know that the BOG keeping like injecting money to maintain the Japan index lower, because they have they suffer from the deflation, right, which is like existing since like the three past decades. And also the EXBX and CXY, so the Canadian currency index, it show if it's starting to be starting to cut the quantity of the money. So we're starting to see if it's the balance sheet will be like shrinking more and more and more, right? So how could we interpret that? Like, as long as we going below this pink zone here, this pink area as the 150, we can consider it as the market or all the central banks pursue the intention for inject a lot of money. So it's a kind of admit that we are in a recession, right? That the recession is upcoming, right? And if we going above this moving average, which is the weighting moving average for the 250, because I use this kind of moving average for the calibration of the heavy currency, right? Because it take the calibration of the heavy currency as the euro index, the Japanese index, and also the dollar and the AUD, which is the Aussie dollar, or NSD, which is the New Zealand index dollar. They play a role as they play the both role, right? Essentially they could be a risky appetite currency, or they could be also defensive currency on the markets. So that's why when you were doing like the algebraic manipulation based on this statistical discrepancy, you will find this kind of after the model, right? So basically we see clearly that the markets, it's on the the red zone, right? And it could stay like this, right? Because we clearly see, as we do a technical analysis, that we evolve to the some of a channel, or something like that. We evolve to the channel, right? We going down, and the direction will be close to the 100. So the more that we go into the 100, which is mean the ultra QE is on activate, and then the index for the indices of the major indices American will show the progression of the oil. Okay, so the hypothetical deductive reasoning from we starting to study the oil, and then if the oil going too much quickly, right, it will impact the value of the bond, right, by the bond yield, because the bond yield is the rate as how much cost for the money to keep money. So if people could not borrow money, it could create some a deflation, because nobody want to expense money, because money is cut a lot. So that's why we studying from the oil. After he will arise the consequences on the bond, and then it will impacting now the indices, right? So that being said, at that time we will see this model for the currency war could go like way down to the 100 or below 100. But the time that we, as long as we going also above the moving average, which is again the 250, and it takes like the period since the previous financial crisis, as we see this model drop off and going below this moving average. It was the time that all the central banks were agreed to inject a lot of money for supporting the economy based on the financial crisis, and then it's starting to stabilize a bit after communicating that we're thinking that we have to stop to inject money, and now we'll take care the balance sheet of all the major central banks. And then the market starting now to stabilize, especially the oil. And also after when they starting again to say we're not seeing clearly the sign of the inflation and also the global growth, so we're keeping and maintaining the money of the, like, inject the money in the economy. So it's a kind of accommodative tones. Then the markets again, the index soar, and then all the bonds also going, like the price of the bond going up, but the rate yield of the bond going down. That's why we see all this currency generally pushing lower, right? So that's why it's very important to follow this model. I built out of that. You can take a look on the article that I wrote, which is, it's called Oil is the True Boss. So the oil is all about oil, right? If I take a look quickly on the oil, we see clearly here. So it's exactly the same situation as we described. Oil is is stable, is between the $60 and $55 per barrel, right? And is very close to the, as we take a look here on the moving average, right, is a 58.33, and now is a 58.15, right? So that's why it's very important. And if you take a look on the report for the EIA, which is Energy International Agency, searched by the global demand and the global supply to see which one the anticipation of this agency about the supply and demand on oil, you will see what will be like the potential opportunity to see which one way that the market could go on the index market. So it depends also the frequency of the oil, also the pace of the oil. If oil like progress quickly and going to reach the 65 level, it will take a time to the market to adjust, right, to follow the same pace of the oil. So it could affect again the portfolio on the bond for the hedge fund manager, and we could see also the market drop off drastically. Okay, so it's a kind of anticipation of the deflation. But if the oil progress quickly, slowly, with the index, and it's accompanied with a great macroeconomic data, then it will support the progression of the oil. And this is exactly the same situation that we are now, right? They recover here as we doing like the bottom here, we're doing the double bottom pattern, and then we stay between the $52 to $50, which is like the global threshold of the oil. It's giving some like an insurance of it's a ratio of the market that the oil would like to follow the index. But be careful with that, because as I said, the inflation is inverted correlated with the bond, right? So if we have a very bad data, macroeconomic data on the monthly macroeconomic data, as the CPI, as we see recently, it will show you also the intention of the Saudi Arabia Iran and also Russia to maybe cut the oil demand. They could extend to the global demand for the oil, and then for support the oil. So it sent the message that they're not feeling great about the potential evolution of the economy. So this move could also putting a pressure on the index. Okay, so at now we are just stable. The more that we're going that like we're going down like progressively to the to this model that we saw for the index, the more also the oil could also moving forward and attempted to reach the 65 level, and then the index also could you know, progress also slowly, right? It's depend on the pace of that. Okay, so that's why I would like to show you for the it's a very interesting model that I made. Very proud of that, and I will recommend you to take a look. And if you have a question also to ask, you can putting that below this video. I all explain the each terms and each variable that I use to build this model, to let me know which one potentially the move that we will have on the financial markets with the index. I'm pretty much sure that there's also the margin that the market could like moving forward, but it's also difficult to see clearly based on the oil, because as you see, the oil here technically as reaching the level here, you know, by the inflation here is drop off, is doing the double bottom and is going up, and is reaching this exactly the same level as he is doing his inflection. So if if we see some a correction upcoming on the oil, we could have also to the bond some like a soar up. The bond could climb, and also the index as a hypothetical deductive reasonment, the index also could going up, right? But is only for the short term. It depend also the evolution for the discussion between China, and also the relation between J. Powell and the President Trump, because he said he is thinking to fire him because he don't want going to the same path as the White House, you know, governance. Okay, so thank you so much for watching this video. If you like it, please leave a thumbs up, and also it helps to support this channel and is keeping us to produce like a professional content. If you have a question also, please leave it up below this video, and we'll see everyone for the next video. Thank you so much, and have a good day. Bye bye.